Have you been looking at your portfolio every single day, watching it get completely depleted with this market dump, and wondering if you're catching a falling knife by buying these stocks on the way down? Or if this market is suddenly about to rip higher and give you unbelievable exponential gains that your friends are going to be asking you, how in the world did you find out about this? Watch this video today, and we're going to tell you exactly what you need to know to make sure you're best prepared for these circumstances. We're going to take you here through today, a market recap of the week, and our thoughts on this using tactical and long-term based results that we say what you should do in this position right now. The first thing we want to start with is what comes out every single week, and we always reference this on the channel, the AAII Investor Sentiment Survey. This survey basically tracks what does everyone think of the market is going to do for the next 6 months. And historically, periods that have been super bearish, like this period right now, where you have a 52% bearish reading on the market, just like a 62% bearish reading on the first week of April last year, after the market rallied up so many points after that, have been historically great times to buy. So that's what we're saying right now. What we see going on with this is people have been getting more and more bearish as the market goes down more and more. The Nasdaq is down about 8%, S&P is down a little bit less than it. But right now people are super scared, and even today we saw a 2% drop. But then after hours, Trump was tweeting out that he might be ending the war very soon and winding it down by passing it off to our allies, and that gave the S&P about a 1% boost after hours. Now you have to take all of that with a grain of salt, because we know one day he says we're going to end the war, then today he's like we're going to send troops, and then we're not going to do something in the future. So you kind of have to figure out what's really going to be happening in the market, and you can't really play off what he's saying because he says so much stuff that's going on, so you have no idea. You have to read off the psychological indicators in the market, the fundamentals of the companies you're getting in, and indicators like this, the bearish sentiment that is overly excessively bearish, and in super times and the readings of it have been great times to buy whenever you have over a 50% bearish reading. So that's a plus for the market to get a bounce here. Another thing that we see is if you go and look back at all of these rallies, right? Look what's going on right here. A huge volume candle on this candle today. And historically, whenever you have huge volume on candles, look at down here at the bottom of the April lows, huge volume, that's preceded huge upturns in the market that has coming, because usually it's the last people either getting out of their short positions or people cramming into shorts that are going to get liquidated by the institutions at the very bottom. So that is why, just from a TA side, we don't use that much TA, but volume usually does indicate the end of the move. We can even just go look at some of these in the past of these drawdowns. Look right here. This volume isn't a crazy spike, but it got up right there. Let's go back here. Let's even go all the way down to 2022 and show you some great examples right here. Right here, look at the bottom here, right? Before we got the big bounce going back all the way up to this, look at how huge this volume spike was. Even right here, this one is an early preceding volume spike, and you can see the volume spiking a little bit on these candles here at the bottom, marking it. But even look at this bottom right here again. Volume spike on that candle, then what does it do? It keeps going rallying up. Just historically, whenever you get this volume spike back in 2020, look, it goes up, and I guarantee you, look at this volume spike on the bottom right here at the end of 2020, whenever the market had a great V-shaped recovery. Look at this volume right here. We don't use much TA on here because it reflects the past, but volume is something that can reflect the present compared to all these patterns, and that can show you that either institutions are getting out of the trades and closing it and covering all their shorts, or it can be a bunch of people loading up on calls and that are going to bring the company or the market or somebody to the upside. So that's just something you want to look. Sometimes the volume can be some short-term events happening in the market, so you got to take that into hand, but we should see a bounce very, very soon. Now, does it hold? That's going to depend on a lot of other things, what Trump says. But historically, right now is a pretty good time to start DCAing in your positions. Like we've been saying on this whole drop down, you're getting so many of these stocks that we really, really like. Let's just go and look in at some of these stocks that we have on our watch list, even here. Like SoFi, look at this. You're getting it down from 32 all the way down to 16, 50% off. Zeta, even better, another triple beat. It was up from 24 and it went down to 15, and you're still getting it at a great deal at $17. Iron up $78. That was a long time ago, but just even this drop is still a lot. And you're still going to get some stocks, like even AMD got up to around 260-ish, and you're going to get at 200, where we think they have a huge prime for the rest of the year. You're also just getting these at different points in time with the VIX going on right here. Look at what happens, like we've been showing you. Every time the VIX pumps up above 50, even above 30, there's always a bounce that happens in the market. Because whenever people, like we said in this survey, whenever everyone gets overly exuberant and overly to one side, that's whenever you really don't get trends that hold, because we've always say this, no one else can join the fight. Just think about anything in your life. Think about if you're in a huge group of people where 99% of the people want to get this one food. You're about to get that food, but there's nobody else to win over to get you that food. So that could just open your options to something else, and people could only leave that side of it. So you just kind of got to think about it. Going with the group in life in anything can work for a little bit, but once everyone's overly about something, just think of anything in your daily life. Whenever everyone believes in one type of thing, that's not how the world works. You have to have balance, and that's what always happens psychologically. Another thing that we see that's actually pretty okay is credit spreads, or the high yield ones, are starting to get a little bit higher a little bit right now, and they're moving, but it's nothing too crazy of a fast move right now. But if we really see these widen all the way up to like 4 point something, then that's whenever you really see the markets pricing in events happening. And also, just these are pretty good because the bonds are usually preceding anything else happening in the market, just because of the fact that the bond traders will take advantage of anything that they can get if they think rates are going to go up, rates are going to go down, and they're the people that are really not based on emotions like everyone else in the market is. So that's just something right there to go look at here. And then here, this is one thing that we want to talk about that is somewhat concerning in the market right now. That's not as many people are talking about, and we don't really know. Basically, Goldman and JP Morgan are giving hedge funds possible ways to short private credit in case that crashes. If anyone knows, the private credit problem right now is a lot of companies are really levered up and took on too much debt, and they can't really pay back their money. You can't really get your money out of these funds anymore. So they're not generating the returns on their investments that they thought they were going to be whenever they took off all this debt. And that could have super spiraling impacts throughout the economy. Because what happens is private credit, they'll loan to private equity firms. And if you know anything, private equity firms will buy M&A transactions, and that will help investment banks will help facilitate that to get them a price in the middle. So a lot of people in investment banking go back to private credit and private equity as just how this all runs. So that just could run the whole and clog up the financial sector. And if we just go and look at this financial industry, let's see right here. This could, you see it's trending down. This kind of usually precedes a lot of recessions, but we've seen it already down so far right now that we think it's already reached its bottom time. So this is just something really good to keep an eye on and see if people get overly exuberant that it's going to come be better, or if they've already bit off too much of the bullet where it's already so far out. And the institutions, what they like to do is they like to delay the crisis so that they can position themselves for the downside sometimes. So anything like a private credit, so if we do a 2008 financial crisis, they're already ready for it. So that's just insider tips that you should know and understand about any of these events happening, and something to monitor and just see what is Blue Owl, what are these companies doing with their funding. Because if anything you know about the system, whenever credit dries up, companies can't get loans whenever they're defaulting. What happens that they go bankrupt, and that's why those high yield, they fly up, because that means there's so much funding stress. And people, to even get those yields, they're demanding so much more yield and coupon payment for locking up all that money for the risk that they're taking. So that's just how everything plays in this economy. Whenever something's more risky, you're going to need more of a yield. So whenever you see those yields for something go up, or even a 10-year, that's people worry about inflation, and they're saying, hey, instead of getting 5%, I need 4%. It's just like if you're in the regular world, right? If you were told that you could get 5 apples right now for $1, but in the future you might be able to get 8 apples for $1, you're going to want a few more apples right now to hedge against that risk of you not being able to buy as much in the future. So that's basically what the bond yields are doing. They're saying, hey, I lock up my money right now. In case this happens in the future, I want a little bit more extra yield. I'm not going to pay 4%. I want 5% coupon payments every year on my money. So that's just where we see the market at right now. There's a lot of interesting things to take a look at, and this could keep evolving if this war keeps going on, which is kind of hard because it's not fundamentally wise. But anytime you're getting somewhat of a dip like this, great companies, 50% off, that beat earnings, have great CEOs, you have to be taking advantage of these prices. Because some of them, like SaaS companies, they've already bought them. Let's just take a look at the IGV right before we leave. This is, while the market's been trending down recently, this has actually bottomed here with that. Look at that happened. That volume right at the very bottom, biggest spike. And it bounced up a little bit. Now it's been coming down recently. But just seeing that bottom and everything, this is on a different pedestal than the market is running right now. So you got to take advantage of these, because imagine this market gets roaring. You are not going to want to be sitting there waiting with all your cash on the sidelines, watching all your friends and everyone else around you get 50% returns. You're going to want to be in these industries that are already beaten down by 50%, that could have 100% upside in just a few months coming out of this. And then you go and you double your money, and any of the losses you have, you added to them, and you have great returns. And that's how you outperform the market, buying whenever everyone else is fearful. So that, we're going to end the video right there. Thank you for watching. Like and subscribe if you want to see more content. And if you have any ideas for what you want to hear more on us about, or for us to investigate any companies you want, leave that in the comments. We're ready to go and get in this journey with you guys and all become better investors together.